We won't have to hear about her anymore. Where did he get these prices?
Okay, let's get cranking. I'm going to start with a couple administrative. I'm going to start with a couple administrative announcements, which I know are going to break most of your heart collectively. So Friday, there'll be no class on Friday. I'm anticipating that a number of folks in this class may want to take a road trip because for the first time in our 123-year student history or school history, one of our basketball teams, the men this year, although the women are coming, have managed to win a berth in the NC2A tournament. And they'll be playing in Monmouth, Oregon at 5 o'clock Friday afternoon against Cal Poly Pomona. And so Friday, I'm intending to go down to watch our men's basketball team kick Cal Poly Pomona's rear ends. And I want to make sure that you guys can too. So your class on Friday will be canceled. If you want to teach, that's fine. But I won't be here. Oh, show up to the game? Yeah, if you show up to the game, no extra credit. Although your fellow students will much appreciate the support. We actually traveled fairly well to Alaska. I was shocked when you saw the pictures. If you watched it streaming, there was a lot of St. Martin's folks up in Fairbanks Anchorage, where the men played Western Oregon to a very, very close 10-point loss, although they were in the game the whole way. And Western Oregon hasn't lost a game in 21 games in a row. They're the #1 seed, and that's why it's a mom. So tragically for all of you, there'll be no class on Friday. And that means that we're going to be moving relatively rapidly for the next 2 days through material. Not that we move all that slowly regardless, but again, no class on Friday. So with that, any questions on, because I know I was looking at the faces on last Friday, and it looked like a lot of the stock stuff was clear as mud. Although when you really start digging in and working the problems, I think you're going to find it's relatively straightforward stuff. So are there any questions on what we covered Friday? I'm going to cover three alternative methodologies of valuation on stock, and then we're going to move to risk and return, which is a pretty critical piece of understanding finance, and it'll likely also slop into next Monday because of no class Friday. Say again? Yeah. Or is next Monday?
Monday, spring break.
Spring break. Oh, okay. Yeah. So yeah, you won't be here. I'll be here. I don't get spring breaks. Okay. So the Monday after that. My bad. I don't get a spring break. I just don't have to teach the class, but I don't get a week off. Faculty gets a week off, but I have 2 jobs, so I don't get a week off. All right. So that means we're going to move even more rapidly through this Chapter 8 stuff. So let me hit some other stock valuation models and there's 3 of them that we're going to touch on, or at least I think I'm going to touch on all 3. The first one is price to earnings ratio. Price to earnings ratio is really common because it's easy to calculate. You've got an earnings, which are the prior year's earnings per share, and then you've got the price, both of which are publicly available. You can look them up on Yahoo Finance, like we did with Amazon in the last class, and you just divide the two, and it gives an indication of the stock's payback period. Essentially, how many years is it going to take for the earnings to equal the stock price? For stocks that have a low price to earnings ratio, do you think those stocks are rapidly growing or not? So if the price is low and the earnings are high, and the price to earnings ratio, let's say, is a 4 or 5, what do you think that tells you about that company? Kind of, sort of. So remember, when we go back to dividend growth model, the higher the price is because the expectation is that the dividends are going to grow rapidly, right? Well, if the market price is relatively low over the earnings, so the price to earnings ratio is relatively low, 4, 5, 6, 7 would be a typical low price to earnings ratio. That's an indication to you, just looking at the price and the earnings, that the expectations for growth of that company are pretty low. As a matter of fact, the expectations may be that it's in decline. Because if the expectations were that it was growing rapidly, what would you expect the price to be? Higher or lower? Higher. Price would be higher if the expectations for future growth were really strong. And so you'd see a high price to earnings ratio. So generally, unless the company is experiencing kind of a hiccup in its operations, and again, any of these metrics, just like when you go back early in a semester and we talked about the KPIs and you talk about ratio analysis, it's tough to take a look at any one of these things in isolation and be able to evaluate a company. But when you take each one of these components and you put them together along with other pieces, it creates a pretty vivid picture of that company's performance. And so if you see a price to earnings ratio that's relatively high, let's say 12 to 17 or 12 to 20, it's likely that that company is growing relatively rapidly. The expectations for that company are relatively good because people are paying a high multiple to earnings to get stock in that company, which means the expectations are that it's growing rapidly, or that the expectations for dividends are growing rapidly if you use dividend discount model, the value. If the price to earnings ratio is relatively low or negative or not meaningful, which would be the other thing you see, because if you have a negative here, you'd have a negative price to earnings ratio. That means that the company is not growing rapidly. The expectations for it are relatively low. So it isn't always a good thing to go, oh my gosh, this company's got a 6 price to earnings ratio. That means it's really cheap. Well, it's probably really cheap for a reason. If you think about growth drives price up. And so this gives you a very easy to calculate, very quick snapshot into the expectations of a company. So again, low price to earnings ratio generally would mean that the future expectations of that company are relatively muted. If you're looking at a high price to earnings ratio, and I'd say high again being in the mid-teens up into the low 20s, that means that the company's expectations are pretty strong. And again, you got to look at all the other components, but it's a good indicator. If the price to earnings ratio starts getting up higher than the mid-20s, that may mean that it had a hiccup, that the earnings were all of a sudden kind of dipped down, or that the company's growing so rapidly that the expectations for it are off the chart, in which case it may be overvalued. So that's just kind of historically where to look at those things. A 246 would be really, really, really high. Yeah. Economic value added. I'm not going to dive much into economic value added. This is one that is theoretically one of the strongest drivers for valuation. From a theory perspective, it's not used often in practice. So economic value added is equal to the EBIT, which is the earnings before interest and taxes, times 1 minus the tax rate minus this calculation, which is essentially saying the return, this is the normalized return on the invested funds. So the cost of funds times the invested capital. And really what you're looking for here is what? If you go to economics, which is this cool term, to go to economics, what are we trying to calculate with economic value added? Yeah, what concept? Any economists in the room? Anybody minoring in economics in the room? I encourage you to do so if you haven't thought about it. You're looking for economic profit. So there's this concept of accounting profit, which is revenue minus expenses. And that's profit. That's accounting profit. That's how most of us think of profit. An economist thinks of profit as excess earnings over a return on capital. And so economic value added is basically looking at, is the company earning an economic profit? When we take out the cost of funds and the invested capital, or when we take out essentially the cost of carrying the invested capital, and we're taking out the earnings, or we're looking at the earnings, we're taking out all the expenses, is there anything left over? Is a company creating economic profit? And if it is, then it's likely a fairly good investment. And if it's not, you're probably looking at a company that's not having an effective utilization of the capital, and so you've got a negative economic value added, which is not going to be a good thing. We've talked about this a couple times. Prices for stocks and any financial instrument move opposite changes in rates of return, because the valuation of a financial asset is a combination of the expected future cash flows discounted at a discount rate or a rate of return. So as that rate of return, required rate of return goes up, the price goes down. And stocks, like bonds, like rental real estate, like any financial asset, are valued essentially the same way, which is, what are the expected future cash flows? What's my required rate of return? I discount one by the other to come up with a present value. I look at the current price and I go, is the current price higher or lower than the present value based upon my required rate of return? If it's higher or equal, then what do? Buy. And if it's lower, what do? Don't buy or sell. So this summarizes it in a little different way, moves in opposite to changes in rates of return, and it moves in the same direction as changes in cash flow. So if cash flow goes up, price goes up. Cash flow goes down, price goes down. Any questions on this stuff? Is it getting more and more clear that the math and the assets are, doesn't matter whether I call it a stock, a bond, a preferred stock, because we're going to get into things like machines and other things here shortly. Is it clear that these are valued largely the same way? The math is largely the same math, and the inputs are largely the same inputs? Okay, because I'm going to say it, you're going to hear it another like 35 times over the course of the semester as I say how we value financial assets. And so fundamentally, this is an important slide. I'm going to jump over to chapter 8, which is risk and return. What we spent a lot of time doing is going, okay, here's how to calculate things based upon, here's a given series of cash flows, and here's a given discount rate. And whether it's stock where you've got essentially no maturity date, or whether it's bonds where you've got a maturity date, you've got a call date, or whether it's abstractions like we studied in chapter 4, we've basically been given the raw components. We've been given a cash flow, we've been given the rate of return, we've been given maturity dates, and we've basically been asked to do the math. We're going to now take the first step into analysis of that required rate of return. The components that go into driving the required rate of return or risk. And this is going to require a little bit of, and I know there's going to be shudders in the room, a little bit of going back to business statistics or quantitative methods, because we're going to use concepts like standard deviation. We're not going to use a ton of statistics, and the ones we're going to use are relatively simple, but you're going to end up back in quant methods again. And so this chapter gives you a little bit of if you're not happy with math and if you're not happy with quant methods, the math will be relatively straightforward, but the concepts are really important. When we talk about risk, it's important for us to think about, and it's important for you to think about risk in a financial sense is the chance that an outcome, expected outcome, will not occur, or that an unexpected outcome will occur. Does this say that you'll lose money? Risk includes, when we think of risk, we always go, oh my gosh, risk is that I'm going to lose money. Risk is that the thing's not going to perform as well as I expected. And as a practical matter, that's the risk that we're worried about. From a math perspective and from a theory perspective, risk includes upside. It's any variation from the expectation. So risk is upside as well as downside. Remember, when you're taking on something and your required rate of return is 18%, that's your required rate of return. There's a probability, and we're going to learn to calculate that, on that it's going to overperform 18% or that it's going to underperform 18%. Generally, when we're thinking about risk in terms of finance, we tend to use things in terms of a normal distribution, which essentially means you've got a mean, and the probabilities that something's going to occur are about equal on the upside and on the downside. So while we tend to think about risk as a one-tailed risk, basically only the downside risk, the downside tail. Mathematically in finance, risk is any variation from expectations. So when we talk about risk, don't think about it as just downside risk, at least in this class. When you talk about risk outside, we tend to think about risk as one tail, basically the left side of the tail of the normal distribution. And there's a probability distribution, which is essentially saying, given any probability or given any possible event, given any possible event, there's a probability attached to each possible event, and we can then calculate what the return is, or the expected return, or the weighted average return, based upon that set of probabilities and the expected returns at each point. And so the math here is relatively straightforward. A lot of weighted average, standard deviation. Weighted average, standard deviation, you're going to be able to pretty well master introductory finance risk. So we're going to start with some simple stuff, probability distribution. When you look at the math behind a probability distribution, you're essentially saying, in this case, you've got a bimodal, two nodes or two modes. Two things can happen. It's either going to rain or it's not, because it's Seattle. Now, this is an optimistic summer Seattle. So the probability of rain is 40%. The probability of no rain is 60%. Your total probabilities have to equal up to 100 because it's either going to rain or it's not. And so essentially you're going to build, if you're going to build a probability distribution, you're going to take each potential outcome, assign a probability to each based upon analysis, and you're going to get to a total. And that total is going to get you to 100%, has to get you to 100%. If you've got a probability distribution that doesn't get you to 100%, you're missing a possibility, or you're missing a potential outcome, or you haven't done your math right. Let's look at a little bit different, a finance example. So we got two potential companies here. You've got Martin Products and US Electric. And you're trying to make a determination as to which one is riskier. Which one is the better investment? Which one is a riskier investment? So you look at, Anyone, by the way, want to tell me, just looking at it right now, which one's a riskier investment? Why?
Because it goes way below the reception.
And what else?
There's a lot more loss there. So that's what I would assume would be, because you're either making a lot off of it or you're getting completely screwed out if things are bigger.
Okay.
When you're still over.
Who would agree that Martin Products is a riskier investment based on what you're seeing here? 4, 5, 6, 7. Who thinks that US Electric is riskier? Nobody. And then the other 9 people don't have an opinion. Okay. Let's walk through it, because we're going to analyze risk and return in light of these two. So we're going to say the economy can do 3 things. It could boom, it could bust, or it could be normal. And we're going to say that there's a 20% chance it booms, 50% chance that it's normal, 30% chance that it busts. Remember, you got to get to 100%, right? So you're looking at, you've got probabilities get added up to 100%, 20%, 50%, 30% equal 100%. For each one of these, a different thing is going to occur. So if we're looking at Martin Products, if the economy booms, Martin Products booms. I mean, they go through the roof. If the economy's normal, they got a 22% return. And if there's a recession, they got a negative 60% return. That's pretty bad. But there's a 70% chance that Martin Products is going to do really well. There's a 70% chance Martin Products is going to do better than US Electric, right? Let's look at US Electric. 20% chance of a 20% return. So it booms. It goes up a little bit. Does well. If it's normal, let's think for a moment. Martin Products might be a technology company. US Electric might be your utility. So when there's a recession, so let's say normal economy, it kind of cranks along 16%. It booms out, we're at 20%, and the economy crashes. The lights are still going to be on. People still need to heat their houses, so it's 10%. So there's a 70% chance that Martin Products is going to outperform US Electric given this scenario. Which one is the riskier investment? Martin Products or US Electric? Who says US Electric is riskier? Nobody. Martin Products, who says that's riskier? Everybody who's still awake. Okay, good. Here's some ways to be able to tell, because you're right. Martin Products is riskier. Without even getting into the math, here's a way to look at how you can tell Martin Products is riskier. The measure of risk, and we're gonna talk about measure of risk, and we're gonna calculate it. Measure of risk is driven by standard deviation. Essentially, how much of a variation can be expected between your highs and your lows. And the standard deviation for Martin Products is really broad. The standard deviation for US Electric is relatively compressed. And certainly in comparison, this is much higher standard deviation than this. So from a finance perspective, even though it's far more likely that you're going to make more money here, it's riskier. Not because it's got a -60 downside, but because the standard deviation is larger. And so let's look at how we calculate that. We're going to start with the expected rate of return first. So expected rate of return is what you expect to get based upon that investment. And it's really just the mean value of the probability distribution. It's taking each one of those components, multiplying it out, coming up with an expected return, multiplying it out, coming up with an expected return, multiplying it out, coming up with an expected return, summing that up, and getting an expected return for the for the outcomes. So it's your weighted averages, essentially. We're going to walk through the calculation of a weighted average, and then we're going to do it for those two businesses. This is the equation. It probably is going to be easier to take a look at. And there's standard deviation. Standard deviation is the difference between your expected return, your observed return minus expected return squared times the probability, all taken at the square root. Standard deviation can be calculated in Excel utilizing a function. So let's look at Martin products. It'll be a lot easier when you look at Martin products. So the expected rate of return is 15%. And the way we came up with that expected rate of return of 15% is we took 20% times 110, 50% times 22, 30% times 60, and added that together. That gave you a 15% expected. They're both the same. So here's how to calculate the standard deviation. You've got 110%, 15% was the expected rate of return. That gives you a 95 as the difference between the observed, or the probable, and the expected rate of return. You square it. And the reason you square it is because you want to get rid of this negative. So when you've got a negative down here, the squaring of it brings it to a positive. And you'll see why you need to do that in a moment. You multiply it by the probability. So that's all you've got here is essentially 95, which is a difference between the probable minus the weighted average, gives you 95. Square it, multiply it by the probability, that gives you 1,805. The second probability was 22%, minus 15%, the expected, gives you 7. Squared is 49, times the probability, 24.5. Minus 60 was the third potential outcome. Minus 15, the expected, gives you negative 75. You square it. And again, when you square it, a negative times a negative equals a positive. And so you get rid of the negative. And the reason we do that is because, remember, we're looking at the absolute, both sides, both tails, upside, downside. And so you want to figure out the total variation, not just the downside variation. And so you've got to square it so that you can see how much of a total variation you get. And so that's where you get 56.25 times the probability gets you 1687.5. Because each one of these is already weighted by the probability here, you just sum these up and that gives you the variance. So the variance, 3,517. To determine the standard deviation, you take the square root of that. So you square it here to make it all positive, and then you take the square root back out here. And standard deviation is reflected as a percentage. So the standard deviation on Martin products is 59.3%. Any questions on this calculation? I would strongly recommend that if you're going to do this in Excel, that you utilize this type format and build the table in a worksheet. take each piece and step it out in each column. It'll keep your formulas organized. It'll keep your answers organized. It'll help you try and make sure if you got to trace back through where there might be a mistake. So I would utilize this format in Excel when you're building it in order to be able to drive to your standard deviation. There's a standard deviation function in Excel, but this is going to be able to give you a little bit more visibility into the various components, and it's not that difficult. Let's walk through the same and do it in Excel. For US Electric. So for US Electric, we've got to come up with what's the first input for US Electric? What are the first thing we need to be able to calculate?
Well, the rate of return.
Yeah, the expected rate of return. So let's go through the exercise of calculating that out. You've got a boom, a normal, and a recession. You've got a probability of 20%, 50%, and 30%. You've got an expected rate of return of 20%, 16%, and 10%. So in order to be able to calculate the expected return for this probability distribution, what do you need to do in this next column? So in order to be able to get what I'm trying to solve for, is the expected return for the probability distribution. So essentially, given that scenario, what do I need to do? You have to multiply. So you're going to multiply that times that. And if you didn't know this trick, you can just pull down on that little thing in the corner. It's called the handle. You can pull that down. It copies your formulas down. And then you're going to hit a sum. So 15%. So the expected return on US Electric is 15%, just like the expected return on Martin Products is 15%. So if you invest in either one, you're going to expect that you're going to get a 15% return. But we want to look and see which one's riskier. Now, we already took a look at look at the big picture and said, okay, the deviation or the variation on this one is significantly larger than the other. And we calculated on the Excel, or you saw the calculation on the PowerPoint of the standard deviation for Martin Products. Now I'm going to walk through, we've walked through how to calculate it here for US Electric. Now let's walk through the standard deviation calculation for US Electric to see how much of a difference there is between the 58% standard deviation on Martin Products versus US Electric. So for US Electric, again, I go back to the slide and say, let's build it similarly to this. Let's build the table similarly to this. So what you've got is essentially same scenarios. Then we're going to put in the return in each scenario, and then we're going to put in the expected return. So the return for each scenario here, oops. And you're going to find there's a couple things that I tend to do on the that I will tend to do on building a spreadsheet which might be useful to you. So generally, you're going to see I'm going to link as many of these as I can. And things that I've got as a hard code or things that I enter in, I tend to color code. I either will color code it blue, either blue letters or blue background, to be able to say, hey, those are ones where I make changes. On these, I don't want to make changes because what I've done here is I've said, okay, that links. So that way, whenever I've got a change, so if all of a sudden somebody goes, oh, wait a second, the probability of this is changed. So this is now 40%, that's 30%. You just make the change once here, it flows all the way through your model and it's done. And so when you're building Excel spreadsheets, a couple things to keep in mind. Again, Dr. Cohen, if you get Dr. Cohen, he'll give you even far better advice than I will. But always color code the stuff that's hard coded. Or color code the stuff that you don't want to touch, one or the other, so that you don't blow your formulas up. And you know, or the person coming after you knows how to use your spreadsheet. So in this particular case, we said the return scenario, the return on each scenario is listed at the top. We've got the expected return. And that's going to be equal to that, and we're going to the next thing that we look at is we subtract the two. So you can see that here we subtract number 1 from number 2 to get the difference. Oops. And we square it. Then we multiply by the probability. Then we sum. Then we take having a hiccup. Square root. I can't remember the damn square root formula. SQRT, right? So now you've got a standard deviation of 3.61%. So did everybody follow how this was calculated? So based upon this, which investment is riskier? So what was the other standard deviation?
The other one was 59%.
59.3. So which one's riskier? Martin Products is riskier because its variance is all over the place. -2 and -60. That's why, by the way, I don't hard code stuff and I use the blue boxes because now you've got the two set up side by side. You got Martin Products here. You've got US Electric here. Which one's riskier? Martin Products. By how much?
By 66%.
You could look at it one of two ways. You could either go, okay, it's riskier by you could go this minus that, or that divided by that. Oops. So it's 16 times riskier. 16 and a half times riskier. So for the same expected return, one is 16 times riskier than the other. Which one are you more likely to buy if the price is equivalent? US Electric. Why? same rate of return, less risk. That, my friends, is the basic concept of risk and return. You've now looked at two stocks, one far more risky than the other, same expected rate of return, except I can't spell return. Same expected rate of return, one is 16 times riskier than the other. You're going to buy the less risky one. Even though there's a 70% chance that this one outperforms the other one. Because math. Yes, ma'am.
How much more, or how much higher would the rate of return for my products have to be in order for one to want to invest?
That's a good question. So, how much riskier would, or how much higher would the rate of return have to be on market products to get somebody to say, this is worth it? Potentially, we'll discuss that next class, because that's more math. It's more math. Any questions on this? Again, when you're building strong recommendation, and I know a couple of you that come to my office for office hours, I've given you this recommendation. Build these things like this or somehow similar. Have them. So you go, this is a standard deviation calculation. Because you're going to find, like I just did, with 3 keystrokes or 4 keystrokes, I'm able to do multiple problems, and I'm able to solve for it knowing that it works without having to rebuild this thing and try and calculate it by hand every time. Excel is your friend. It doesn't take long to do it right, and it doesn't take long to have a couple of these little tips and tricks that are going to help you move through things a little bit more rapidly. Yes, sir.
For the purposes of this class, the front headers, and section, those aren't changing over the course of the problems.
They might.
They might.
For the purposes of this one, no. But, I mean, if you wanted to change them, it's easy enough to do so.
I mean, like, nothing changes radically other than what we call it.
Correct. Correct. Any other questions? So that's, if I just change the probabilities, it flowed all the way through and gave you different standard deviations. Okay, I will see you all on Wednesday.